The market right now is, well, it's just full of volatility. And when that happens, fear really takes over.
It does.
And one stock that's been on a real roller coaster with this is MP Materials.
Oh, absolutely. If you've been watching MP, you saw a very sharp drop recently. The stock closed just under that $64 mark.
And in those moments, the whole story just becomes negative, right? People start selling just to be safe.
That's the default reaction, yeah. Pure caution.
And that is exactly why we're doing this deep dive, because the analysis report we've synthesized today, it presents this powerful counter-narrative.
It really does.
It looks at this dip and just completely rejects the fear. It calls it a classic flash sale opportunity. You know, a moment where short-term panic just creates a discount.
Our mission today is really to unpack the data points that support this very aggressive buy the dip idea. This isn't just about a quick trade. The analysis sees this as a calculated move, a shakeout, setting the stage for something big.
Something big around the February earnings report specifically.
Exactly. So for you, the listener, if you're trying to get ahead of a really time-sensitive investment argument, this is kind of the shortcut.
We're synthesizing why this analysis sees MP Materials as a major growth and, I guess, recovery play, not just for now, but looking out towards 2026.
To do that, we first need to get our footing. We need to understand the technical setup, the drama of the last few days, and then we can dive into the three huge catalysts that this report claims are driving, a potential 25 to 30% upside from right here.
So the big idea is that the market is just missing the boat on future profits and maybe more importantly, some kind of government protection.
That's the core of it.
Okay, let's start with the drama on the chart then. What exactly happened over the last few trading sessions to cause all this anxiety and set up this so-called flash sale?
Well, the trading pattern was pretty telling. The stock had some real momentum. It opened recently around $67.
And it was trying to push past 68, right? The recent high.
It was. But instead of breaking through, it just hit a wall of selling pressure. The report describes it as getting hammered down to that close of 63.82.
When a stock does that, when it reverses right at a key resistance point, the first thought is usually, okay, the rally's over. Fear.
It is. But this analysis reads it completely differently. They don't see it as a fundamental failure at all.
So what do they see it as?
That's what's so interesting. They chalk it up almost entirely to short-term profit taking. The idea is that traders who got in lower just decided to cash out at that $68 ceiling.
Instead of holding on through the chop.
Exactly. So it was driven by nervous sellers, not by some bad news about the company itself. The long-term story is, in their view, unchanged.
Okay, so if the fundamentals are solid, then the technicals are all about finding the bottom. Finding that floor.
Finding the floor. Yep.
So what's the key level they're watching that makes or breaks this whole buy the dip idea?
It all comes down to the $63 price level. That number is called out as a massive support level.
And it's holding so far.
It's holding. For the bulls following this thesis, holding 63 is, well, it's everything. If it breaks, the argument falls apart. But as long as it holds, what we just saw is interpreted as a classic shakeout.
A shakeout. That's a term we hear a lot in market psychology. For anyone who doesn't follow this stuff daily, can you break that down? Why is a steep drop that holds support actually seen as a good thing?
Sure. A shakeout is basically a technical event that's designed to maximize fear. It violently pushes the price down to a critical line, but not through it.
And that forces the nervous investors, the ones with maybe too much leverage, to just panic and sell their shares.
They've been shaken out before the move that everyone was actually waiting for.
I see. And that creates a perfect entry point for someone with a longer-term view who's more confident.
Precisely. It sets up a really favorable risk-to-reward ratio. Your risk is defined by that $63 floor. If you buy at, say, $63.82, you know exactly where your stop loss goes.
But the potential upside, driven by the catalysts we're about to talk about, is much, much higher.
Exactly. You're positioned for that 25 to 30% upside they're talking about. So this setup frames the current price, not as a danger zone, but as a strategic entry.
That makes a lot of sense. So massive support holding, fear creating a discount. Let's get right into the first and, the most timely catalyst this report is banking on. The shift from spending money to making money. They call it the profit pivot.
Right. And this directly tackles the biggest problem MP Materials has had for the last year or so. If you look at their recent history, they've been in this intense building phase, pouring capital into their empire, so to speak.
And the result of that is that they've been burning cash.
Burning cash. And Wall Street hates cash burn, even when it's for a good reason, because it just kills your earnings per share number.
Right. That negative EPS has been a huge weight on the stock. It keeps the more traditional investors away. The story has been great idea for the future, but not profitable yet.
That's been the narrative.
So according to this analysis, when does that flip? When does this pressure point finally turn positive?
The expectation is pinned completely on the upcoming Q4 earnings report. We should see that in mid-February.
Okay.
The analysis projects that this is the moment. This is the inflection point where MPIA will flip the switch back to positive EPS. They're moving out of that expensive construction phase and into the cash-generating operational phase, at least for their upstream business.
That transition from consuming cash to generating cash is so critical for a growth stock. But, I mean, isn't positive EPS eventually expected? Why is the February timing so important here?
The timing is everything because the market reaction to this kind of news is almost never gradual. Growth investors are just waiting for this specific proof point.
The green light.
It's the green light.
Right.
Once the company shows can go from investing for tomorrow to printing cash today, the market instantly re-rates the stock. The analysis argues that this change is just too big to ignore.
So the argument is, if you wait for the good news to be announced, you've already missed a big chunk of the move.
You've already missed it.
Hey,
Exactly.
yeah.
The whole bullish case is that you want to be in your position before that news drops. You don't want to be chasing this stock after the institutions start piling in.
So this profit pivot is really the engine for that immediate 25-30% upside target?
That's the short-term driver, yeah.
Okay, so the profit picture is looking better and it's imminent, but there's more here than just financials. The analysis talks about this massive strategic firewall providing downside protection you almost never see in this sector.
Right.
Let's shift to that geopolitical angle. Catalyst number 2, the Uncle Sam's safety net.
This is where the story gets really unique, and it separates MP from just any other mining company. The sources are very clear in framing MP Materials as a true national security asset.
Because rare earth elements are critical for defense and technology.
They're essential. And this isn't just, some patriotic branding. The report points to real, concrete government support. Specifically, the U.S. Department of Defense is involved, and there's mention of a $400 million investment.
Wow, $400 million.
That financial backing is huge, but the real benefit is the mechanism it creates. This partnership provides what the analysis calls the ultimate safety net. It protects the company from the single biggest risk in mining.
Which is commodity price crashes.
Exactly.
So how does that work in practice? Does the government just promise to buy a certain amount no matter what?
They've established a price floor for MP's products. This is the key detail. It means that if global prices for rare earths, which are notoriously volatile, if they were to collapse,
The DoD steps in.
the DoD steps in. They guarantee they will buy MP's output at that pre-agreed floor price.
That is an incredible level of security. So if global prices tank, the government basically guarantees their minimum revenue.
It completely changes the risk calculation. For a normal miner, a price crash can be catastrophic. For MP, the downside is structurally limited by the Department of Defense.
And what happens if prices go up?
That's the best part. If prices soar, MP gets the full benefit. They can sell in the open market at the higher price.
So it's a win-win. Downside protection and full upside exposure. That really strengthens the whole idea that this is a low-risk entry point.
It does. It gives them a strategic moat that very few companies in this space can claim. It reinforces the company's fundamental strength, regardless of all the short-term market noise.
Okay, let's move to the final piece, the longest-term catalyst, but maybe the most lucrative one. We've got the profit pivot and the government safety net. The third catalyst is about what's happening at their Mountain Pass facility. The analysis calls it the 10X plan.
This is the real long-term game changer, the thing that drives that 2026 forecast. Right now, if you look at how the market values MP, it's mostly as a miner and extractor.
They're selling dirt, as the report puts it, which is a low-margin business.
Exactly. Low-margin extraction is never going to get a high valuation multiple from the market.
So the current price is based on the old business model. What's the shift in this 10X plan? Why does it change the profit profile so dramatically?
The change is a vertical move up the value chain. They're going from selling raw materials to selling finished high-tech products. Specifically, they're starting to manufacture advanced neodymium permanent magnets.
And that's what costs all the money right now, that CapEx.
That's the cash burn we talked about, but it completely flips the profit equation on the other side.
So tell us about these magnets. Where do they end up, and why are they so much more valuable?
Well, these are not your refrigerator magnets. They are critical components for high-growth strategic industries. We're talking about the magnets you need for high-efficiency EV motors,
Okay.
for next-generation wind turbines. And maybe most importantly, for precision parts in things like fighter jets and guided missile systems.
So the company goes from being compared to a mining company to being compared to a specialized high-tech industrial manufacturer. That sounds like a total re-rating opportunity.
That is the absolute core of the valuation argument. The analysis is very clear. Selling finished magnets carries exponentially higher margins and justifies much, much higher multiples.
And that transformation is expected to really kick in by 2026.
That's the timeline. So the idea is you are buying a company today that's priced with a commodity multiple, but which should, in a few years, have a high-tech manufacturing multiple.
So that gap, the difference between the price now and what the price could be, that's the real long-term opportunity. And the February earnings is kind of the first step to the market waking up to this.
That's the bet. The magnet revenue won't hit the books until 2026, but a strong positive earnings report in February validates management's ability to execute.
It builds confidence.
It builds a ton of confidence.
Yeah.
If they can deliver positive EPS now, it gives investors faith they can pull off the much more complex 10X plan, and the market starts pricing that future in today.
That is a pretty powerful stack of arguments. You've got the immediate profit pivot, the government safety net, and this huge long-term valuation re-rating with the 10X plan. Let's pull it all together. What's the final verdict from this analysis report, and what are the specific price targets?
The verdict is unequivocally bullish on buying this dip at this price. The immediate target is a bounce right back to that $68 resistance level.
Back to where the selling started.
Exactly. That would be the signal that the shakeout worked and it's over.
And beyond just that technical bounce, as we get closer to the February earnings.
As we approach mid-February in that profitability news, the analysis is projecting a run-up into the $80 range, or even higher, assuming, of course, they deliver on the numbers.
And that move from around $63.80 up towards $80, that's where the opportunity is quantified.
It is. That's the 25 to 30% upside potential they're talking about. It's all based on getting ahead of a positive earnings report and the excitement that will follow.
So for you, the listener, you're now fully up to speed on this aggressive thesis. But we have to acknowledge the risks here. I mean, this whole thing really hinges on management executing perfectly. First, on the profit switch, and then on the huge manufacturing build-out.
That's a perfect way to put it. The analysis is aggressive because it assumes that future execution. But even if you factor in the normal risks of a project like this, you still have to weigh those unique strategic elements we talked about.
Which brings up a really important question for you to think about. Given the protection from that DoD price floor, that safety net limiting the commodity risk, how should you weigh the risk of a potential negative earnings surprise against this promised 25–30% upside?
Does that government backing truly justify buying the fear right here at this specific price? Does it make the financial risk worth the potential reward? It gives you a lot to think about, really, where national security meets market valuation.